Okay, good morning, everybody. It's Friday, June 26, 2020. This is Dan Russo, Chief Market Strategist at Shaken Analytics, bringing you another episode of Stock Market Today, where it's Friday and we go over key themes and relationships as they relate to risk sentiment in the marketplace. As always, Shaken Analytics brings you Stock Market Today. Head over to shakenanalytics.com/today to sign up for a free email where we get a lot of the content for this show. Bring you daily stock ideas to consider that hits your inbox every trading day before the market opens. So U.S. equities higher in Tuesday's trading, closed near the best levels of the day. Financials were a big gainer, helped by a rollback of some Volcker rule restrictions. We can debate whether or not that makes sense, but it is. Energy, tech, and materials also outperformed. Utilities were the only sector down on the day. Treasuries were mixed. Dollar was stronger on the major crosses. Gold down 30 basis points. WTI crude up 1.9%. Pretty quiet summer Friday here as we get going. S&P futures up about 20 basis points, near the best levels of the morning. Treasuries are unchanged to slightly weaker. Dollar's weaker on the yen and euro. Gold is up 20 bips. WTI crude adding on up 60 basis points to kick us off on, as I said, a summer Friday morning. S&P 500 structure, support holds, dips are bought, right? Once again, basically you just go back to yesterday's show and take what I said and apply it to today, right? Tried to break the 200-day moving average, couldn't. Rally. 3,000 to 3,100 remains support, 2850, 2950 below that. As long as support is holding, the Feb highs are in play. Resistance 3150, the gap to 3250, the June 8 highs in the near term. We are near oversold conditions based on that 13-period CCI. And shaken money flow is bullish. So for the most part, the song remains the same, right? The structure of the market hasn't changed all that much. For those of you who get our notes, you'll recognize that I wrote our note on Sunday. And I said the risk reward for the S&P 500 was fairly balanced, and that, barring no major move today, that's proven to be 100% accurate. So that's the structure of the market. I think above 3,200, you're aggressive on the long side. Below 3,000, you are managing your risk and looking for bearish opportunities. In the middle, find what's working, find the relative strength, identify the areas of the market that are leadership. We're going to look at one a little bit later on in the show. And those are the areas where you should be skewing your portfolio as far as I'm concerned. But that's always the case. If you want to outperform, own what's outperforming. All right, so our market in a minute. What are we writing about in the note? Well, dip buyers continue to defend the key support levels for the S&P 500. Same goes for the IWM as well. New highs for growth versus value. So for those of you who have been on board our 16-month view now, that growth over value is the way to structure your portfolio from a strategic standpoint. Kudos to you. You have another new high to celebrate today. Risk appetite is stable this week. Biotech is leadership, but overbought in the near term. Futures point to a higher open today. Taking a look at the power bars now. For the major indices, Dow tacks on 1%. Everybody kind of tacked on 1%. What's interesting is that the small caps outperform on up days and underperform on down days. Interesting dynamic that I've just noticed. I don't know if it means anything, but just kind of interesting. So the Dow up 1%, 4 bulls, 10 bears there. S&P 500 up 1%, 86 to 135 bulls to bears in that camp. NASDAQ up 94 bips, 33 to 15. There's your small caps up 1.5%, 505 to 292 bulls to bears. Bonds actually higher, sending yields lower. And financials were your big outperformer, as we are going to apparently roll back some of the Volcker rules. That'd be interesting to see how that plays out, but it was viewed as constructive for the banks. Our stock of the day is ARNA Pharmaceuticals, ARNA, the ticker symbol here. Bullish stock, strong trend above a rising long-term trend line, strong industry group. You have a nice rounded Consolidation pattern here, breakout, retest, and moving higher once again. Bullish stock outperforming the market. Look at this bullish money flow as the overbought, oversold indicator rounds higher and is exiting an oversold position. ARNA Pharmaceuticals is a bullish stock in what we will see is a leading area of the market. And here is what's interesting to me. Leadership been in place off the lows. All right. This is a really intriguing name to me. The setup here looks compelling. I think if you're looking for bullish ideas, you could take a look at ARNA Pharmaceuticals, ARNA, for a potential bullish opportunity in the here and now. Let's look at our sector tracker, movement of the major sectors over the last 5 days. All red except for tech. What is tech? Growth. Technology at the top of the list, healthcare, discretionary. Those are your growth sectors. Those are the areas of the market that you skew to when growth is scarce in the world. If you read my note today, you'll see once again the trend in the copper versus gold ratio. That's my proxy for global growth, or at least in investor expectations of it. It's been in a downtrend for 2 years. And in that time, growth has outperformed value. Continues to be the case. Materials, financial staples are middle of the road. Industrials, REITs, utilities, and energy bottom of the list. Your rotation trade, your reflation trade that everybody was getting really excited about a few weeks ago, I'd say we can call that one off for now. Maybe I'll be wrong. And if I'm wrong, I'll gladly change my view. But so far, I'm not wrong. I haven't been wrong. I've called this trade counter trend in nature from the start, and I think it continues to be the case. Our industry in focus, transport services, over the past 6 months has underperformed the S&P 500 by 15%. And it still has a weak power bar ratio, 8 bulls to 12 bears, currently ranked number 14 of 21 subsectors. Names we want to avoid in this group, names where we potentially want to look for bearish opportunities if you trade that way: Kansas City Southern, KSU, Kirby, KEX, and Allegiant, ALGT. All with very bearish Chaikin power gauge ratings for as holdings in a fund that I would make the case you should not have been touching since December. Up here at 65, down to 35. Neutral rating, I mean, above the trend line. The question is this just a bear flag right here? Right, for those of you who are classical chart pattern people, right? Big move down, upward sloping flag before maybe heading lower. The key will be the break. You'll have to watch it. It's not there yet. But the group just doesn't look that compelling to me, right? I mean, first the ratio. I mean, I'm willing to look at neutral groups, but they have to be outperforming, and that's not the case here. The transports are lagging. They've been lagging, and the intensity of underperformance is starting to pick up, right? Like there was some brief hope here as the intensity of relative weakness started to diminish, but now it's going the other way again. So I think odds favor this being a bear flag and likely falling out of it, but I could be wrong, right? We all could be wrong. If I'm wrong, we'll pay attention to it. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers are gainers and losers. National Oilwell Varco, nothing company specific to drive that stock up 9.8%. Bearish stock, part of this energy group that's been beaten down, NOV, not interesting to me. Accenture, on the other hand, is a quality company in a leading area of the market with a bullish rating, right? I think all else being equal, I think it pays to own good companies, right? National Oilwell Varco is not a good company, and it's not a good industry group. Accenture is a great company in a leading area of the market. It's pretty simple, folks. Noble, right? Another one, not a good company, very bearish, up 6%. I don't want to own it. AMP, Ameriprise Financial, right? One of the bright spots within the financials, AMP is a good company. They were upgraded by Goldman Sachs yesterday, up 6% yesterday. PXD caught an upgrade as well. That stock up 6%, but a very bearish rating here at Chaikin Analytics. On the loser side of the board, Cabot Oil and Gas, COG, very bearish stock, down 4%, nothing company specific. JW Nordstrom, JWN, right? Coronaviruses are picking up around the country, right? Shopping. You're going to want to go out there. There's a lot of moving parts to what's going on here still. Down 3.75%. Pulte, PHM, down 3.72%. Kohl's, another just a bad retailer, down 3.5%. Neutral rating in HRB, very bearish stock, down 3.4%. Nothing company specific on anything, right? We can make the case that JW Nordstrom and Kohl's are coronavirus related. We can say that Pulte is likely a derivative call off KB Homes, but other than that, nothing company specific driving trading in these names. New highs in growth versus value. And this is a sight to behold. It really is. Because, new highs are new highs, but it's just a nice steady uptrend. Right? Confirmed by momentum as the RSI has sustained bullish ranges. Hasn't been oversold since way back here. In late 2019. But it's just a nice steady uptrend for growth versus value. And what's amazing to me is that this is across market caps. And it lines up with what we're seeing at Chaikin Analytics. If I go in and look at kind of the large, mid, and small cap growth ETFs and the large, mid, and small cap value ETFs, for the most part, the growth ETFs are bullish or very bullish. The value ETFs are neutral, right? So that combination of fundamentals and technicals keeping you in the trade that makes the most sense, right? And so when I think about what that means from a strategic standpoint, right, when you're looking for ideas, all else being equal, I think it makes sense to own growth over value. And I've thought that for over a year now. And quite frankly, it's been the right call. Here's the cues relative to the SPY going out at all-time highs. High beta versus low volatility. I think for the risk sentiment perspective in the notes that I write, I think this is one of the more important ones, right? Risk got deeply oversold. We snap back, maybe we overshoot, and now we're back here to the breakout level. I think that if you're looking for increasing risk sentiment in the market, you'd want to see high beta outperforming low volatility. Now, that hasn't been the case since 2018, which coincidentally is the time that growth started to slow down. Coincidentally is the time that growth stocks started outperforming value stocks in a bigly way. So I think it's important. I think this line in the sand here is important. And a further breakdown would tell us that there's just not a lot of risk appetite in the marketplace. So that's something we're watching closely. It's above the 200-day moving average for now. It's holding bullish ranges for now, right? You can actually draw this line here if you wanted to and call it a support level at around the 50 mark. But a breakdown from here would be more of the same. A rally rebound from here would say that maybe things are shifting in the marketplace. This is why we're watching them. This is why we bring them to you in real time. We want to see when new trends are developing, and we want to see them as quickly as possible. Right now, I'm sticking with the views that I've had for the most part. Growth over value, large over small. If you're going to dabble in small, stick to the growth side. A more conservative stance. I think a diversified portfolio makes a ton of sense. Right? Balancing out your equity portions with things like gold, things like treasuries, right? I think that we could be seeing some shifting tides in the market. And, as those shifts play out, there could be volatility, and I think you're going to want a level of protection. Finally, leaders lead, biotech. And I say leaders lead because look at this. This trend is in place, right? They outperformed through the March sell-off and continue to outperform. IBB going out near 52-week highs, breakout, consolidation, breakout. Close to overbought, so not necessarily a chaser here, except for better companies and better setups like that arena that I showed you. But look at IBB relative to the SPY. This is what I mean. Look for the leadership through downturns, through consolidations, because that's likely to be going to be your leadership coming out. Folks, I hope you all have a great Friday. Take some time this weekend to sign up for our 14-day trial. I'll be back Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.